Hello, this is Connie Belden, and we're going to start out where we left off in the last video. We're going to return to our original data. As a reminder, the selling price per unit was $30. The variable cost was $18 per unit. The contribution margin is $12 per unit, and fixed cost is $48,000. So returning to the original data, how would the break-even in units change if the selling price increases by $2 and fixed cost increased by $2,000? So we'll use the same formula we used before for break-even in units. Fixed cost divided by contribution margin per unit. So our original fixed costs are $48,000. We're going to add another $2,000 onto that. So our fixed cost will now be $50,000. Now the selling price is increasing from $30 to $32 per unit, so that means our contribution margin per unit will change. So our new selling price is $32. Our variable cost, though, is still $18. So our fixed cost is $50,000. 32 minus 18 gives us $14 for our new contribution margin. If we divide that out, we do get an odd number, so I'll round it up to the nearest whole number. 3,572 units would be our new break even. Okay, let's go on to letter I. Returning again back to the original data, so our selling price is 30 and our contribution margin per unit is 12. Fixed cost of 48,000. What would the new net income be if sales decrease by 100 units? Remember, sales are currently 4,500 units, so it's going down to 4,400 units. Now we're assuming fixed costs don't change here, and so that means net income would go down by the $12 contribution margin per unit times the 100 units decrease in sales. So we could put it into the following formula. The original net income is $6,000. In this case, it's decreasing, so I will subtract the decrease in sales of 100 units times the original contribution margin per unit, which is $12. And when you multiply that out, you will get 4,800 when you multiply it out and then subtract it from 6,000 as your new net income. Now, at any point, you could put any sales level into an income statement to prove what the income is. So let's go ahead and see what would the new net income be if we sold 5,500 units. So let's go ahead and start with sales. The selling price is still $30. So 5,500 units times the sales price of $30 means sales would be $165,000. We're going back to the original variable cost of 18 times 5,500 units is 99,000. Subtract to get the contribution margin of 66,000. Fixed costs remain at 48,000. Take 66,000 contribution margin minus 48,000 fixed cost. And at the sales level of 5,500 units, your net income would be $18,000. Okay, let's move on to letter K. We're going back to the original data of sales of 4,500 units. How much will net operating income change if the advertising budget increases by 5,000? The sales volume increases by 100 units, and the total monthly sales increased by $3,000. Well, we could put this into an income statement, but the easiest way would be if sales go up by $3,000, and remember we calculated earlier back in part A that the contribution margin ratio is 40%. What we can do is, first of all, take 40% of the $3,000 increase in sales, But then we would want to subtract out the $5,000 increase in fixed costs, because that increase of $5,000 in advertising would be considered an increase in fixed cost. So what I will do first of all is take 40% of 3,000, and then I would subtract out 5,000, and that would give me a negative 3,800. So therefore, there would be a 3,800 decrease in net income. Next, let's take a look at letter L. Return to the original data. What would the additional net income be if sales were 1,000 more than expected? Again, we're assuming that fixed costs don't change. So if sales go up by 1,000, that means it would increase net income by the contribution margin ratio of 40%. So that means there would be a $400 increase in net income. Okay, last we're going to take a look at operating leverage here. Operating leverage is easy to calculate. You just take the contribution margin divided by the net income. And again, we're going back here to the original data where contribution margin is 54,000 and net income is 6,000. So I will take 54,000 contribution margin divided by $6,000 net income, and you get an operating leverage number of 9. Well, what does that mean? Well, that means how sensitive you are to changes in sales. Because if you have more tied up in fixed cost, you're going to be more sensitive to the change in sales. Because it's hard to change fixed cost. It's hard to change the amount you paid for rent. But you could save money, for example, on food by cooking your own rather than eating out. So variable costs can be adjusted easier. So now let's put that in play in letter N. What is the new net income given the operating leverage of 9 above and sales increased by 20%? So again, the original net income is $6,000. We'll add that to our operating leverage of 9 times, it says sales will go up by 20%, so 0.2. And then take that times the net income of 6,000 to verify its increase. Okay, so I'll do the inside brackets first. 6,000 plus, so 9 times 0.2 gives you 1.8. And then we'll take that times 6,000. Then 6,000 plus 1.8 times 6,000 is 10,800. So your new net income is 16,800. So as long as sales go up, a high operating leverage number is fine. But if sales go down, in this case, for example, by 20%, net income would go down by 10,800, giving you a negative or net loss. That completes this video.